Hi everyone, we're live at the weekly stock market update. Apologies, I am 1 minute late on this. I've got in from various meetings, and as you can see, I've not even had a chance to get changed. So I do apologize for that. It's been a busy old time. Everybody knows the drill. They know to tell me where they're from. Alex in Northern Ireland. Hello, Mukund. Hello. Welcome one and all. Do let me know where you're from. It's always useful for me to know whether this is a first time webinar for you. I am going to put on screen the weekly stock market update. Apologies, I'm just warming up my throat so I can give a better webinar performance for you all. And that's why I was drinking there. Okay, so if we are all one and all ready, welcome Charles, Ilya, Marguerite, everyone else. You should be able to see the screen as well. Just drawing to your attention some things which have come across my desk, which I thought were quite interesting over here, which is US equities. I'll read this out on screen anyway. I know some of it's a little bit sort of difficult to read. And you've got the NASDAQ over 3 years, 54% up, 1 year, 24%. Right at the bottom, the micro caps and the small caps over 3 years only up 10%, and the micro caps only 4%. Of course, it used to be the case. People would say that the smaller companies are the ones which will give you the outsized returns. They're certainly the ones which tend to be more volatile. They are the ones which tend to be therefore higher risk, volatility and risk meaning the same thing. But it's certainly not been the case over the 1 to 3 years. Now, that's been very satisfying for the simple reason that I'm always a lot happier if I've got big household names than if I've got some no-name tiny AIM stock. I used to invest in AIM stocks as a young student, but not so much now. Lee, Paul, Martin, everyone else, we've got new Arizona, Glendale, Arizona, Whitney, hello, wonderful. And as I say, anybody who's first timer, let me know as well. I also want to share with you this one, the countries and their symbols for their exchange traded funds, just out of interest, in case you want to have a look, and we'll cover ETFs later on. There's the ETFs for the various countries. And over the last 3 years, of course, the US 35% return. Germany coming in second. You might not know there's a Germany ETF, and then you've got France at, well, pretty mediocre returns over here. Okay, and then negative returns have been China, though it might be China's year this year, and Brazil. It might also be interesting for Brazil. I'm going to do a separate, I keep saying this, I'm going to do a separate webinar on ETFs or videos on ETFs. Well, in actual fact, the good news is I've actually got that presentation. It's ready. Had time not already begun to start this webinar, I would have already done that recording, but I will post it. You will find it on at some point on my various channels, okay? My various views on various exchange traded funds. My Great Investments Program people will get the full shebang and they will get all the details. The public will get snippets, all right, which is only fair. So that's where we are with this. Now, what does this show? What does this show? Well, what it shows is you're paying $27 for every future dollar of profits in Microsoft. You'll have heard me say this week in, week out. I apologize if ever I repeat myself on things. But valuation is not the only thing that moves stock prices. Otherwise, all these in red, where you're paying lots in the share price to buy a future dollar of profit, which is a measure of valuation, how much you're paying for future profits, they would be the underperformers, and the ones in green would be the best performers. And you could look, some of you, one of you out there might be in university and might say, oh, I'm going to do that as a hypothesis. I'm going to test this. I'm just going to short the ones which are expensive and buy the ones which are cheap, hold it for 3 months, and then do the exercise again, and then rotate again and again and see if I make outsized returns. It's not an experiment I've done. But the reason we don't just look at valuation is because, well, most obviously, as you know, the overvalued ones, because they've been growing, have, in terms of revenues and profits, have been doing rather well. So we tick a lot more boxes than just valuation alone. So if you've got an IFA or a fund manager who says to you, oh, I'm going to put you in a value fund and then separately into a growth fund, they're being stupid, because unvalued companies could remain undervalued for a long period of time because they don't have growth, and growing companies could remain about to collapse off a cliff because they're overvalued. So you can't look at growth without valuation and valuation without growth. Otherwise, you're looking at one side of the picture and you're asking for trouble. And you can't mix two separate funds, which are just value and just growth, and expect the combination of the two to be suddenly undervalued growth companies, because they're not. There's a bunch of overvalued growth ones and undervalued non-growing ones. That's what you've got. So instead of one piece of stinking manure combined with another piece of stinking manure, you suddenly don't get roses blooming. Okay, so very basic lesson in investment management there. Now, this is the earnings calendar. I know it could be a bit difficult on screen. Feel free to take a screenshot or a picture or anything else as well. We've got everything from Solihull here to Dave, who is in the poshest place I've ever heard of, Newton. Is it Newton Le Willows? That is really, you have to tell me where that is, because I want to come and visit. S&P 500 earnings calendar. Now, I'll tell you what's interesting on this one. Okay, it's actually on this page, and it's this. That's the biggie. All right, that is the absolute biggie, because that is important, not just for the stock market, the NVIDIA results on the 26th of February. That is important also for the state of the US economy, on this whole tariff issue. So it is politically important, which is putting a double whammy onto what it might mean for the stock market. From Suffolk boy, I'm from Leeds. We don't get out much. I didn't know. I mean, Suffolk is just so posh for us Leeds boys. Right. So there's your NVIDIA. Don't forget to do all of these things, especially if you're on TikTok. I'm broadcasting live on TikTok as well. Now, I'm going to zoom into this because you can all download a free copy of this later, but I'm going to zoom into this. What is this? I did this earlier in the week, different types of investors and stop losses they should use. Now, don't read this right now. Everything from individual investors, long-term investors and their stop loss strategies, percentage-based trailing stops. It's really comprehensive. Swing traders, day traders, fixed dollar volatility base, hard stop, mental stop. And it's really pretty good. It's on my Telegram channel. If you don't know where my Telegram is, have a look at alpeshpatel.com/links, alpeshpatel.com/links. But it might be useful to you. You might just take photos of it anyway and not bother going to the Telegram channel, download it, entirely up to you. It also shows you the stop losses institutional investors use on the hedge fund side, dynamic stop losses, risk parity stop losses, etc. I will probably do a video on what these things mean, okay, for those interested. Though some of you might say, listen, Sunshine, I'm not an institution. I couldn't care less. I'm an individual investor, long term. So all I need to know is percentage based or trailing, like 25% from entry or 25% trailing stop loss. That's all I need to know. What everybody else does, I couldn't care less, you might say. Okay. So I just want to draw that to your attention because I'm really proud of that, actually. I'm easily pleased. We've also got this, which is on the same place on the Telegram channel. What moves stock prices? Now, I'm going to give you, before we dive into the webinar and look at the stocks that I like, what I don't like, which ones have performed the best over the past month, and what I think about them now. The reason I wanted to show you this is, and remember, if you're already on my Great Investments program, you don't need to watch this webinar, okay? Because this is the public one. You've got your private version that I've already sent you. So this is extra stuff you don't need to watch. What moves stock prices? Okay, now, as you can see, there's a hell of a lot of stuff. There's market forces, external factors, of course, industry trends, common traits of successful companies, effective risk management, adaptability, technical factors, trading volume, chart patterns, investor behavior. Oh my God, earnings reports, revenue growth. And this is not even comprehensive. Okay, in terms of what moves. I mean, I could put in there, I don't know if it's included somewhere as a subtitle, Donald Trump's tweets move stock prices. So what's important for us in any decision making, including what is likely to move the stock price in the stock that I've just bought into, is what's important, how important is it? Because not all these things are equally important. And if they fall below a certain threshold, well, we can probably ignore them. A bit like, the butterfly flapping its wings in China, really we can ignore for weather forecasts in downtown Solihull. Okay, so it's a similar thing with this. And for me, as you will know, those who follow me, the way I narrow all of that down is not to wrongly then one morning wake up and just follow some of this, and then I read in the news some political event and then decide to give that too much weight, and then randomly, haphazardly, I read somewhere that some companies increase its profit margin to give that a bit of weight. Instead, we just have a very consistent, steady process, which is this. Okay, I need all of these to be green. It's just a different way of reminding you what I remind you each week. We want them to be undervalued, growing companies with good cash return on the capital they invest. So basically a license to print money, preferably in the top 25% of all companies buy that. None of these meet all my requirements. And we want them, Sortino's high average return with small drops and quick snapbacks. Okay, because that's ideally what you'd want. If you're reverse engineering the ideal stock price movement, forget company, the ideal stock price movement. Because think about it. How do you make money? You don't make money because a company's good or bad or anything else. You make money because you sold at a higher price than you bought. So if we strip it down to its most simplest point, then you want companies whose stock prices have high average returns, and if they fall shallow, i.e. small drops, quick to rebound. That's it. Okay, that is the sum total of what you want. So in a way, that's reverse engineering, and we want that also to be green. But none of that guarantees that our stocks will rise. Why? Because there's so many factors that even AI or a quantum computer would find it difficult to forecast. So we just put in and weigh the most important things, which I showed you: value, growth, income, sorting. So I just wanted to recap that, but from a different way from what I say normally. And don't forget, look at this: herd behaviors in there, speculations in there. How have we combined that? That comes from the momentum side of things. Okay, that came from the momentum side of things, where I looked at 6-month returns. Right, so they're rough and ready in some regards. You might say, hang on, that's pretty thorough, Alpesh, but that's still leaving out so much information. Yes, but it's pretty good. Okay, it's pretty good to get me across the line. So if there's market tailwinds, we do well. If there's headwinds, we might even have to go into cash and jump out despite all of this data and all of this information. Okay, so the point being, it's good enough to give us the return, and then we can go and smell the roses. We are not quantum mechanic academics trying to win the Nobel Prize in economics and be perfect, right? So that's an important point, I think, to get across. Now, this is year to date, the S&P 500, and you can see the sectors at the bottom. And I'm just showing this out of interest, really. It's interesting. The financials, which were some of the cheapest stocks, are pretty much the only sector in which you're okay. As in, you could just throw a dart at a dartboard. Actually, the 0% line is this. Okay, the 0% line is this. And the ones which have got more above the 0% than below is pretty much just the financials, isn't it? Okay, everything else seems to be as equal up and down. Maybe the industrials, maybe some of the energy, but the energy rarely escapes. It rarely gives you sort of, and of course, the S&P 500, the spider, the SPY, is there, and you can see. Well, that's where that is. Now, if you did 2 times leverage that, you'd be a bit higher and you'd be up here. And there's a few companies which have done better. And you might say to me, Alpesh, why can't you just tell us these ones? Okay, well, sometimes we get those, but very often, no, I don't have the crystal ball. What tends to happen if we go for some of these is you do end up with some of these. So some of the ones which underperform. That's why you have your stop loss, to make sure you don't get too much to the downside. So you have asymmetric upside to downside, which is basically you have a stop loss to cut your losses and you let your winners ride, which is another way of saying we're still playing the numbers. We're playing the numbers still. Okay, we're just trying to avoid stupid mistakes by looking at the data, by doing it. Anyway, there's nothing more to read into this. Please don't make the mistake that is so common amongst humans, our fellow humans, which is they see patterns where none exist. There's nothing more into this. Okay, don't over-hypothecate it and say, well, Alpesh, does it mean that perhaps this or that? No, there's nothing else into this. Right now, over the past week, this is how the markets have moved. Once again, don't read too much into this. Apple has had a bit of a bounce up, Palantir as well, CrowdStrike right up there. Coca-Cola up about 7% in just a week, which is pretty good. Booking as well. We'll talk about some of these as we progress through this webinar. Intel, 38%. There's some talk it might be broken up, but then again, if you look at the Intel stock price, it's been absolutely bloody battered, and what an amazing name, what amazing resources. And they might go the GE way and break themselves up, and clearly the market loves that if they do. And by the way, even a 38% rise in a week still sees it way off its historic prices, historic average prices. So there could be something. I'm surprised somebody hasn't taken them over yet, but clearly those who've looked at it have thought not worth even taking over, because it really has gone to multi-year lows. CVS, will come back to Gilead, Life Sciences. But beyond what's gone up, don't read into it some kind of sector rotation or anything else. The biggest mistake people make is they read too much into things. In other words, they give weight to things that they have no right to give weight to. Okay, that's why. Dave, it's not posh, it's on the Merseyside. Oh, Cheshire. You mentioned Cheshire and say it's not posh, Dave. Oh, I don't believe you, my friend. Hello, everyone. Right, now, past year. This is what it's looked like. Get your laughing gear around that, as they say. That is pretty amazing. If somebody said to me, and here's the interesting thing, let's say you removed all the numbers, and that'd be a good parlor game. If anybody has a parlor. Dave does, because he's posh. Posh Dave's got a parlor. If you if you said to me, okay, I'm going to remove the returns, fill them in, and how they've done in the past year, I would not in a million years have got Apple 32% and Microsoft 0. By the way, I don't have a problem with this, and I continue holding it. I don't have a problem that it's been 0, because it's been bringing in lots of cash into the company, into Microsoft being, making lots of money, and I think it'll catch up. So no problems at the moment. And we're going to, so I continue holding it. Okay. We'll have a look at some of the, look at that, 59% JP Morgan in a year. Bank of America, Wells Fargo, Walmart, Costco, amazing. And these are off the back of profitability. Not all of them, but most of them off profitability. Amazon 32, Tesla 87, helps when your best mate's the president. Apple, Google, Meta. Now, you might say to me on some of these, what about the narrative, Alpesh, that people aren't buying Teslas anymore because they don't like the politics of Elon? I'd say I'm going to look at the numbers. I'm going to look till the numbers come in. And if you don't like the volatility or the narrative, then my number one rule, if in doubt, keep it out. You're not obliged to. If in doubt, you should be able to sleep like a baby with your portfolio. It should not be an element of indecision, uncertainty. And that's why Warren Buffett has so much money in cash. Because if he can't have a good night's sleep, he doesn't deploy it. Okay? Excuse me for drinking it just helps with my throat and the talking that I'm about to do. So let's do a deeper dive. Now, I have got the ETF video, not the video, the presentation ready. My data people have got the data ready, and the graphics people have put the graphics together for me. So it is ready. All it requires is my voice to analyze and go through it. Well, delete a few slides which are not relevant, in which I will go through international, global, commodities, crypto, all of these things I will cover in that separate video. So keep an eye peeled on that. I'll post it on my various media as well. I'll do a detailed version for the Great Investments Program. For everyone else, you get little snippets of things, which again, I think is only fair. This came across my desk and I thought it was very interesting, which is obviously there's some news about gold. Elon Musk said he's going to do a live, Fort Knox is going to go into live and see if there's any gold in there, because all the conspiracy theorists on social media say there isn't. What's interesting is this: gold as a commodity, i.e. the physical gold, okay, has gone up. But the stocks, the gold stocks, the miners and all the rest of it, they've barely budged. Okay, so I don't know what the companies are doing. I don't know whether it's because, I don't know. Are they paying too many bribes? Are they inefficient in their mining? Whatever the hell it is, are they paying too much away in salaries, bonuses to the chief executives? And so their profitability is just not rising, so the stock price is not going up, because the price of gold, it's the physical gold that's been going up, not the companies, not the proxy Okay, there are, by the way, some physical gold ETFs. Is it too late? I'm not a gold specialist. Okay, it's not my thing. But I just wanted to show you this because I thought it was fascinating, the gap. Now, you might say, wait a minute, Alpesh, this can't be sustained. And there are a group of traders who would short the physical and go long the security. So you would short the gold commodity and go long that, because you would say that this gap on average tends not to be this big and it's going to shorten. Okay, so that's what they do. Now, you and I are not going to do that. Me, because I'm too lazy. You, because it's a bit too complicated. But there is an argument to be made for doing that. Okay. Price to earnings. This is the multiples you're paying in the US market on the various sectors. This is just for interest, forecasted growth. I'll tell you what interests me later, but for now, I'm giving you information. Some people don't like being given information. They just want my opinion, but I actually like to give people information. Okay, forecasted growth in the US market overall is 14.5%. Price to earnings is 31. Some of these are more expensive, some are less. I'm not going to read into this that I should suddenly go into energy because of those two numbers, that although it's cheap and it's going to grow a little bit, or anything else. I'm not over reading into this because I like to look at individual stocks. I'm a bottom up, not a top down investor. So let's look at the US market and how the last 7 days have gone. Well, AppLovin, which we came to belatedly, is up some 32%. By the way, have a look at what that company does. AI advertising for app installations, and it's just making money for old rope. Because it's a software company, its cash return on capital invested is significant. It's not making chips like NVIDIA, graphics cards rather, like NVIDIA. Alibaba, and this is the whole China story. Looks like the Politburo are getting back onto growth. They summoned the heads of various of their big billion-dollar companies, including Alibaba, reprogrammed them at the Politburo and headquarters, and then said to them, go out and grow. So there could be a China story in here, and that looks positive. So I'm going to keep an eye on seeing if there's any Chinese exposed stocks which tick my boxes. Tesla, I think we're going to cover later. NVIDIA, I continue holding these. That was one of ours from November or December, I forget which is a bit belated, but we tend not to get in when they're tiny little risky companies. Okay, so where are we on the UK market? Well, you can see price to earnings valuations are there. There's forecasted growth, my friends. That's where the forecasted growth is. So you can see which sectors are forecasted to grow the most. Materials. If you're looking for a job, you might want to sort of see which companies are in the materials sector and apply there. And if you're looking for a job, probably best not to go into, well, actually financials, I guess best not to go into. Are you kidding me? See if you can get a job in financials, because the money's bloody ridiculous. Now, UK market, which have been the biggest movers, it's been these good old favorites: HSBC, BAE Systems, AstraZeneca, Rolls-Royce, Rio Tinto. Rolls-Royce up 95% up over the past year, and up another 4% this year alone. Sorry, this week alone. Okay, some of these I'll probably do a separate webinar on just UK stocks alone, I think. So how's the past year been? Well, the past year has been like this. The Nasdaq is 25%, S&P 22, UK surprisingly 17%. That's been helped by sterling dropping significantly against the US dollar. So US dollar profits in UK companies look, when converted back into sterling, look bumper. Okay, now I'm going to give you an important lesson, which I've said before. The thing about the markets is only 1 times out of 4 does it actually do what you want it to do. 3 times out of 4, it doesn't, and it pays not to panic. It pays to sit on your hands to get your 25%. What does 25% look like? Well, it looks like the 1 time out of 4 when it goes up, okay, like there, and the other times when either it's falling, or goes up and then drops, goes up, then drops, okay, or goes sideways and gets you 0% return. So 3 times out of 4, 75% of the time does bugger all. For instance, Microsoft in 2021 went up 50%, but 9 months out of 12 made 0 or negative returns, making my case and my point for me. Similarly here, Okay, so what's the lesson? The lesson is not to panic every time, as long as you're into something already good, like these, not to panic every time there's a sneeze or get frustrated and impatient when after 6-7 months you've got 0% return. In the words of Warren Buffett, the stock market is a mechanism for transferring money from the impatient to the patient. You know, last year I did barely anything, and the index itself helped. The rising tide helped me look cleverer than I am. Okay, S&P 500. This is where we are. That's what it looks like. All right, now, best case scenario, this trend continues and you get another 25% over the next 12 months. A third year in the S&P of positive returns is more likely after 2 positive years than not. It's more on the cards than not statistically, but history is not a guarantee of the future. This suggests we've got to keep a vigilant eye that we don't get this scenario. If we get this scenario, I'm out and I'll be holding cash. Okay. So what is this? What is this measure? Well, what it is this. And again, forgive me for repeating myself for the newbies. Okay. If that's the average price of something, then what this measures is the short-term price getting too far away and therefore likely to revert back to the average mean price? Okay. And equally, is it undershooting? So is it doing this? So if it's overshooting, is it more likely to pull back? Now, equally, the average price could be on a slope and you could get this, right? That's all it's measuring. And sometimes what happens is you can go like this and it goes and starts moving up. In other words, take NVIDIA before AI, NVIDIA after AI. So the average itself can move. That's what makes investing a little bit tricky. The point being, this could just keep going up and up and up is the point I'm making. And with a lot of companies, that's what's been happening recently. Now, bottom line, I continue holding my S&P index tracker. I continue holding 2 times leverage on S&P and 3 times leverage exchange traded fund on S&P. No action, nothing needed because my exit hasn't been hit. In other words, I have a very simple process. I don't worry about the world and Ukraine and the Middle East and anything else. What I worry about is, has my exit rule been hit? No. And the exit would have been the daddy bear scenario there. It hasn't, so I don't need to do anything. This is the daily to have a bit of a microscope look. Okay, all-time high. Now, what's happening there? Well, it should break out through there because that's what's known as, well, you can either call it a triangle or a wedge. I think they tend to call it a triangle. And if you get a breakout to the upside, what tends to happen is it tends to go to the upside as much as the mouth, i.e. the peak to that angle is there. So you can see, again, ample upside potentially. NASDAQ, I continue having 3 times leverage ETFs on that and 1 times. My son's junior ISA tends to have fewer holdings because he's 6 and it's a junior ISA, so there's not much money you can put into it. So I don't try and divide it into 20 stocks. He tends to have the index trackers, okay, on the leverage front. That's where I get the additional risk for a young person. You know, they say young people should take more risk because they're younger. Well, what we do it is with the ones, whoops. Apologies for the Slack messages. Let me just close that. There we go. And that's the trend upwards. And you could see, look, if it bounces too far off even the trend line, it sort of tends to revert back to a mean. Okay, so where are we at the moment? Well, I'm not worried unless it breaks below there, but I'm actually not worried unless it gets a daddy bear scenario a bit like that. So there's 2 ways of looking at it. In other words, I've got no action to take. Making money, sitting on your backside and not having to do things is shameful when you're from a place like Yorkshire, because sometimes people say, this is disgusting, you should get a proper job. You're right, and week in, week out, I do these broadcasts, and I say there's nothing else for me to do, and I'm just watching it. And since January 2023, we've just been watching it, and it's just been going on. What do you want me to do? There's nothing for me to do. There's nothing to worry about either. The reason Warren Buffett lives so long is because he just has few worries, and I have few worries. I look at this and I go, well, it's another week where I don't have to do anything. You know, a lot of people get into business and entrepreneurship because they're fundamentally lazy. But Richard Branson said that. He sounds lazy, so I just thought I'd be a businessman. And it's the same with investing. If you're lazy, it's the perfect job for you, because really you don't have to do much. And what you do is in front of a desk. FTSE 100. Now, why has the FTSE got an all-time high? That's because the pound has been falling, partly because of worries about growth, and partly because, well, that's it actually, worries about growth. And now it looks like interest rates will stay high for longer, so maybe the pound will recoup a bit, and that could put downward pressure on the FTSE. The reason is FTSE 100 companies put their earnings in pounds, but they earn the money in dollars. So when they convert it from dollars into pounds, or the accountants do, notionally, even at the 6 monthly ends when they're doing the reporting of the accounts, then what happens? It looks like they've earned a lot more profits than they actually have because it's in dollars. But they might be spending it in dollars as well. But anyway, in the future. But that's why it sort of gives this artificial lift, and the momentum looks like it's going to continue for a little bit longer, which surprised me. But there we are. Now, I continue holding this. That's the ETF. Don't do leverage. It is for people like me who like doing leverage and want extra returns. Okay, I tend to do leverage only on those with lower downside volatility. Look at the downside volatility on this. So I like to find things where the drawdown, peak to trough, that's called the drawdown, okay, and the duration till recovery are short. So I want ones with small triangles. I don't want blooming massive drawdowns which take forever to recover, obviously, okay. And in those, I have no problems having 2 times leverage for obvious reasons. If the drawdown's small, then magnifying it doesn't harm me. The mistake people make is they go out there with live ammo. They'll find ones with massive drawdowns, and then they'll go, oh, I'll do leverage on that. Absolutely insane. Don't go near it. So especially given that we're talking about pensions and ISAs and those kinds of things. Top 10 S&P 500 stocks over the past month. Okay, which were the biggest movers, my friends? They were these, bloody Supermicro. Again, oh my God, it just doesn't stop. 81% up. Palantir, 73. CrowdStrike. So we're going to look at all these, by the way. Intel. And then we get into ones which, well, Tapestry, CVS, which has been lagging for a while, Philip Morris, Fortinet, Uber. I did a stock report on the Great Investments Program on that one. Netflix we've been covering forever. CVS has been one of our holds from last year. Palantir I did a stock report on as well, and obviously Supermicro was the big knockout win of last year for us. Okay, so let's go into this now. Supermicro, whilst it's a 7 on my value growth income, it is on the weekly starting to move up, but really that's moving up as well. So this could be projecting forward, right? I will do a detailed report on the pros and cons, the risks and rewards, and the actual strategic plan. So what we do on the program is I give a stock report to my clients rather than just buy it, which would be a bit stupid. But actually the reasoning so they can work it out for their risk appetite, because this is not suitable for everybody's risk appetite. Now I say this, and I'm going to try and pull out some paper. He says, hopefully, I've got an M&S envelope here, that'll do. And so I'll do a stock report on that for my Great Investments Program people, so they've got some detailed analysis on reward, risk, and all the rest of it. Because if you just go willy-nilly into these, you can see the danger, and you need to know where stops should be, and you need to know projections and the risks and the rewards, and when to exit. Maybe you exit half here, half there, and so on. But at the moment, that's definitely one looks interesting. Now, Palantir, I've already done a stock report on, so I'm not going to do a new, fresh one. That would be if it went up. But personally, I wouldn't want to be holding it below that level, which is a 50% drop. So be warned. Doesn't look it on the chart, but it is. But then again, the upside's quite significant were it to continue. Now, one of the reasons Palantir and some of the other cyber companies are doing well is, when people hear defense spending and they hear Europe's going to have to look after itself more, et cetera, et cetera. Well, defense spending in the modern world is not just hardware. It is not just tanks and General Dynamics and F-35 fighter jets. Although to reverse the trade imbalance between the United States and the US, the Indians have said, well, you're right, you've been giving us a load of dollars, we've got a surplus of your dollars, in other words, a trade deficit for the United States. Can we use those dollars to buy F-35 fighter jets? This is what said the Indian Prime Minister to the Americans, and the American president said, "Yeah, all right." I mean, talk about win-win then. So it's not just hardware like that. This is software. Cybersecurity threat from China and Russia and North Korea to a lesser extent. Those the North Koreans who were behind the NHS shutdown, which, if you remember, happened. I think it was last year, wasn't it? And of course, the North Koreans are helped by both the Iranians and the Chinese. So it is companies like this, and they are the real deal. I mean, this is not some. I mean, have a look at their website. What I love about investing is you learn so much about the world because you can look at the websites of these companies and see what they do. This is one worth looking at. Okay, AppLovin is one worth looking at. AI in ad spend is worth looking at. CrowdStrike is another one. Remember, these were the Muppets who stopped all your flights at that time, and they dropped so much and people panicked. Anyway, they've obviously recovered and all has been forgiven. I want to show you something interesting as a pattern. You see this, where the MACD, which is a measure of moving average prices that I discussed earlier, notice how it just kisses its own moving average and then bounces up again. That's typical. And if you want to avoid panic, you'd actually wait for it to cross over rather than just panic on an exit. And of course, in case you hadn't already got out. Anyway, CrowdStrike is another one which is looking like it would do well in that direction. The problem is it is overbought. Okay, so it is riskier for that reason. You know, that's all I'd say to you. It doesn't meet our criteria of 7, 8, or 9 either. Intel doesn't meet our criteria of 7, 8, or 9. So you would decide, well, okay, if it doesn't, then I don't want it. But if you say, well, I don't care, Alpesh, then that would be the most optimistic projection on Intel. And you might say, well, actually, I don't think that's way too optimistic. I mean, come on, Alpesh, JP Morgan gave it a sell on 31st of January. I'm going through these because these were the ones on the monthly update. Sorry, the ones which has gone up the most. And there's your stop. Okay, so you can see what your risk is, and you can see what the upside is. Then you might say, bloody hell, if it drops to 18, Alpesh, why would I want to sell it then? It's not going to go bankrupt, not going to go to zero, is it? So there we go. Tapestry is a 7, but it is overbought. So as long as you're willing to take that extra risk of it being overbought, you can see what the projected direction is and you can see where the stop would be. So good reward to risk on that one. And I will probably do a more detailed report for my Great Investments program on that one, possibly also on why not Intel as well, to see if it is worth the reward risk, because I'm not 100% sure, of course, whether it is or not. Okay, so there we go. Now CVS has been a bit of a pain because look at that. Okay, we had it dropped, and now it's back to where it was, and should be starting to do that. There's your upside. If you get that upside hits, you got almost 50% in returns. And I think, look, there's no point putting a stop loss all the way down there, is there? Okay, I think with something like this, you'd probably put it there and say, look, I want to get that, so I'll get the hell out sooner. It is an 8. I don't like the volatility on this, okay? So I'm not going to do a special stock report, and I don't want it because I'm fed up with the volatility on it. I don't like the fact that it can do this and then that. Sodler's Law being what it is, it'll probably go up 50% now. But we'll probably keep an eye on it for you. Philip Morris, 9, great, overbought on that. Okay, which means it's too far extended from its average long-term average price. If you think of this as the sort of long-term average price, it's far extended. Okay, and therefore there's a greater propensity it'll move back to its long-term average mean. It's not guaranteed, but it might do. Martin said chip manufacturers moving back to the US. You may well be right, Martin. They're certainly moving from China to India, though that is not a rapid or easy move. But yeah, thank you, Akram. Do you know, I'm not kidding. I got in, Akram wrote, nice suit, Alpesh. I got in and I, from various meetings, and I sat down, I didn't even have a chance to change. And I've been sitting here for 4 hours now because I was just doing various bits and bobs and calls and things. So Philip Morris, That's where we are on that one. Fortinet is a 7 for us. A little bit overbought. You can see what happened there when after it rallied up, and then because it was overbought, it just went nowhere, actually down for a while. That'd be the most optimistic case. And because it could do this and you don't want to hang around, you'd have a tighter stop. You just say, well, I'm going to put the bloody stop loss there. Okay. So that'd be the reason for that. And I'll do a more detailed analysis for the Great Investments Program on that one and decide whether or not it is something worth looking at in more detail. But as I said, it's one of the big ones. Uber is a 7. Again, you can see the problem. It would have to do that. And again, with this, I guess you'd say, right, stop loss would be there. If it drops below there, you might even put it shorter on the basis that if you think it's going to go up there, it shouldn't go down here. Okay, but it is a 7, as is Netflix, which we've been covering for donkeys, as you know, ever since it dropped sharply there. And this often happens with US stocks. Look at these sharp drops for prolonged periods of time, and then all of a sudden, never looks back. And it's because all the sellers panicked and got out there. They threw up into their popcorn. And then, of course, it just went in one direction. Okay, is the 9 your rating, or is it 9 on the filtered list? 9 is on the filtered list. Okay, which is my rating. They're the same thing. Measurements of value, growth, income, cash flow, Sortino, alpha. So this is a 7. 7, 8, 9 meets my minimum criteria. The problem with this is it's overbought, but it's been overbought for a while and it could keep on going. We just don't know. So for those who like that risk, then there you go. There's your direction. Very simple. And does it excite me? Yeah, it excites me on that basis. But I don't want somebody who says, well, actually, I'm quite risk averse getting into it for that obvious reason, because of this. Okay. Costco is similarly right there in that direction. Okay. And you can see it could keep going up. Now, Costco I cover because it's a stock market update and continues looking attractive, except you've got to be worried about that part of things. So you would just keep a close eye on where you're going to put that stop, which could be there, it could be there. All right. These I'll just cover for my clients on the Great Investments Program. Bank of America Corporation, I've been covering since I think it was back here. I don't own it, right? And that's the direction of play. Again, were this to start looking like this, then you'd expect this to peak out. At the moment, that's not the case, so there's nothing to be done in terms of you're already holding it, nothing to be done. And you might say, well, should I buy it today? Well, that's the thesis for it going up, and you'd probably want to put a stop there if you do want to take that view in light of that being overbought. You probably don't want to hang around too long. So you'd say, well, okay, I'm going to take that view, but I'll exit if that happens. So I'm risking $4 in order to make what is that? $14, $15. So that's the right way to look at it. A famous hedge fund manager who I interviewed many years ago called Bill, I think it was Bill Lipschitz who said this. He said, or it might be Bernard Oppenheimer, anyway, one of them, really legendary hedge fund managers. They said to me, you can't eat like a bird and dump like an elephant. What they meant is you can't say, oh, I'll risk 14 in order to make 4. You can't dump like an elephant and eat like a bird. It's the other way around. You've got to do it. All right. That's why it's structured this way. They taught me that. I'm just applying what they taught me on investing, and they're stupidly rich. No, I just did Netflix. Walmart is a 7, as you know, and there you go. So that's eating like an elephant, and you're just going to poop like a bird. Okay, were you to do it on that one? Okay, I'll probably still might do a whole load. Okay. Now, Berkshire, where are we on Berkshire? See, overbought, but it's still dragging ahead bit by bit by bit. So you got your 29.75, and you'd probably say, oh, I don't want to see anything below that, right? I don't fancy giving us a special buy for those who watch your videos but don't have the funding to yet buy. I think I've given loads in there. Eli Lilly and Company, So with this, you're looking at that, and there's your stop. All right. There's your special buy if you wanted it. There you go. Right, that's where we are on that one. Making a note of these to look into more detail on some of these. Now, Walt Disney we had last year, and it again a pain, a bit like CVS, sort of dropped and then recouped all of it, and in the money again, and then so it's just going along steadily. Now, whilst it's an 8 and the momentum is rising, I don't like that volatility. So, to be clear, don't do it. I don't like the volatility. I just don't like these pullbacks. Now, I say that, sod's law, it'll just make 60%. And somebody's going to go to me, you missed it. But if you are going to do it, Oren, there's your 60 to that side and there's your stop down there. In fact, just put your stop at 100. So you're risking 10 in order to make 80. Sounds pretty sexy, yeah? And then you owe me a drink afterwards. This is how we did last year when we had our January video. So we're already in February. So I haven't looked at my February videos and so on, but January for my clients, we did a January video, January the 11th, on the stocks that I like and so on. These were the best performers of those. Okay. Overall, it wasn't a 500% return for us overall. Sadly, there were some which didn't do amazingly well. And so it came down to 41%. But that's largely because it was a good year in the market. The markets had a tailwind. If they have a tailwind, you do incredibly well. Classic example, last year there was a tailwind, so Meta went up, 100%? 2022, when we had to hold cash, thankfully, Meta dropped 74%. Luckily, we didn't have it because we had to be in cash for everything because average prices were falling. So the point being, if there's a tailwind, whoom, massive. If there's a headwind, okay? So, and that's the bit people forget. They all think, oh, give me a special tip, to use your terms, or I'll make loads of money. Well, actually, no, a lot will depend upon other factors. And it doesn't mean that the same company will every year make the same return. You know, Meta 2022 down 74%, right? Now, I try and get this across to people. I know somebody criticized me for talking about my credentials all the time, so I'm not going to, because I forget sometimes. Two things. One is you've heard it all before, so you don't need me to tell you. And secondly, as Warren Buffett says, we don't have to be smarter than the rest. And I'm not. We have to be more disciplined than the rest. That's it. That's my discipline, is this. I'm not smarter than the rest. My God, Matt, I discovered that when I was 16, that I didn't have to be smarter than the girls at my school in order to get the maths, physics, and chemistry prizes. I just had to be more disciplined at making sure I did what I was supposed to do to get the prizes. That was it. I wasn't smarter than them. They were cleverer than me. I think all three of them that we had in our class. And it's the same point here. You don't have to be smarter than the rest. You just have to be more disciplined. And that's really is true. We have an entry checklist. You can take a picture of it if you wish. I don't think I'm giving anything away from the program by showing this. Okay. Thank you for everybody who submits testimonials. It doesn't go to my head, right? But it is, do you know that awful term, humbling? It is, because I don't expect it, and then it happens. And I can't take credit for it because there's amazing companies which make the returns that need to take a bow and take the credit. Amazon and NVIDIA, didn't I do NVIDIA? Amazon, I can't. Amazon and NVIDIA, and I'm giving both for the Great Investments Program. They're in the program. So this was Palantir. Palantir, oh, that was it. Bought this in 2022, a few months after your special situation. And of course, it's up. God knows how much now is Palantir since 2022. I did a special situation broadcast on it, and it's gone through the roof. So it's always good when the positives happen. Of course, let me give you what happened last year. Out of 29 companies that we mentioned in our sort of filtered broadcast in January of last year, five had losses by the end of the year, even though we got over a 40% return. 5 out of 29 didn't. That keeps you humble. Okay, we can't see into the future. Cannot see into the future. It is dependent upon those companies doing what their numbers suggest they will do. It's like me hiring somebody, and then at the end of the year, the guy does what his CV said he could do. Great, I look good. He doesn't, turns out to be rubbish as an employee. I look stupid. I wanted to point this actually because this is really important. Some of you will be interested in dividends. And this is from Bloomberg, and I think it was this morning, or it might be yesterday. BP has distributed billions of dollars to shareholders over the years, largely in dividends. Okay, and the problem with that is UK companies have a pressure to deliver dividends. And when they deliver dividends, because income funds crave cash over growth, then what happens is that money comes to you. And so BP doesn't have it in order to invest in its future. So eventually it ends up not growing. And eventually it ends up cutting dividends. So it kills a company. You're basically killing the goose that lays the golden egg, because you want it to keep producing golden eggs until the poor goose is knackered, all right, and then dies. And that is a British disease. Actually, it was, the title to this was what the British disease is. So if you're one of those people who says, oh, I'm a dividend hunter, listen, in the 1960s and 70s, possibly even in the 80s, that was fine, but the world has moved on. You can go for growth, and you better go for growth, because in going for your dividends, you're getting shafted. Because what's happening is you're getting your 6% dividend, and then the company's dropping 30%. Okay? So be warned. You must, well, then I'm going to hold it forever. No, it's giving 6% this year. Then it's dropping 30%, but you're holding forever, so you're thinking it doesn't matter. And then it's cutting its dividend to 3%. And now you can't get out at a 30% loss, and you're stuck with a 3% bloody dividend. Okay? So you're screwed on both ways. You're handcuffed into a lower return. I don't like hunting for dividends. I did an article about this in the Financial Times many, many years ago, probably about 20 bloody years ago. Same old, watch out for these funds. If you're in any of these, just please be careful. They really are really bad producers, not just the funds, but the issuers. They time and again perform poorly. And that's because they do what I said to you before. And here's another bunch of names. If you've got any of these, just please be careful. I keep saying it. I keep giving the warning each week. And the reason they perform so poorly is because, like I said earlier, they'll say, right, we're only going to have undervalued companies, or only growth companies, and they'll only look one side of it. It's not because they're stupid. It's because they've got so much money. If you had hundreds of billions to allocate, you too would divide it into all sorts of gimmicky little funds to capture the money, because one thing that they know for sure is people hate filling in forms to take their money out. Okay, and that's what they rely on. This poverty gap between UK and US pensioners, you need to behave like an American. Right now, that might not go down well at the moment. You need to behave like an American. In other words, you need an American pensioner who is getting somewhere between this index and this index in returns. Okay, some of them might be doing better, but they're generally getting between this index and this index. Okay, and you've got to be less like a British pensioner who's getting this. How do you do that? Well, your SIP and ISA can do that, or your general trading account in your company can even do that. Okay, so just to say, and like I said, I love it when the education I give helps. Emails this week, an update on carnivals was mentioned I will happily, yes indeed. There was a whole bunch. Thank you. And if there's any others which I can cover, yes, you're right, and I have it here. Carnival, I did mention that. You're absolutely right. And I'm going to pull it up on screen in just a second. Perfect. Thank you very much for that. In fact, let me do that now. And then we'll get back to the other stuff. So Carnival, and remind me of any others that I put, Alistair, if there were ones which, and I'll check NUE as well. So this is Carnival PLC, okay? And what you can see is that MACD is moving up nicely. It's been from an overbought level, but down here, it sort of let you down. And then it fell back, and then it started moving up again. Now, the thing about Carnival here is the weekly is falling, the monthly is rising. What that tends to mean is it's probably going to go sideways for a little bit until both of these move in the same direction. I'm using TradingView if you want to look it up yourself. Okay, and that's the monthly, and that's the weekly. All right, that's how I've set it up. So in case you want to do it yourself, you can do that. I'm just going to tell you what it is. Just give me 1 second. I'm just going to put up I'm just going to look into what it is on the what's getting me on the financials in terms of for Carnival. Okay, CUK. You just reminded me that. Give me 1 second. Right, Carnival. Here we go. In terms of numbers and what's going on, the worrying thing here is gearing. It's got a lot of borrowing, but actually the price earnings ratio, not bad. Cash return on capital invested, not phenomenal. So the fundamentals are not, there's no massive red flags on it. So like I said, I would, when that's the case, I would tend to focus more on this and say to myself, look, as long as it doesn't drop below this and the momentum starts rising, so as long as the price doesn't fall below that, I've got nothing to worry about and I'd be holding. Would I buy it? No, I think there are better opportunities out there for me. So I'm not really looking to buy it. But if I was holding it, probably would continue holding it. That was it as well. Okay. Alistair, if there's anything else, if there are any others on that email, just remind me and put them across and I'll cover them for you. Somebody else mentioned something else. NUE. Can we cover NUE? I will cover NUE. NUE. Nucor. Yeah, I think I'd mentioned that somewhere, hadn't I? Just be careful, if whatever pensions you've got, and especially if you've got a company and you haven't got a pension, please also look at that. Please be careful as workplace pensions to have a look. The default pensions in a workplace pension are usually just default and rubbish. So please be careful about that. And this story is well worth reading. It is how people think, oh, I'm okay, the FTSE all-time high, sweetheart, I'm sure my pension's okay, and they don't look at it. And the reason is pensions hold a lot of bonds, and if the price of bonds has fallen, then the pension value can have fallen, which you might think is not a problem for you because you think, oh, I don't need to worry because they're going to hold the bonds until the maturity. Well, no, it depends when you're going to retire and the duration of the bonds. Have British fund managers become pointless expenses? Just be careful about this, okay? I mention it each week, but that's why, right? And everything that I've told you is based on things I've written in my Financial Times columns anyway. So I don't want you to think, well, where the hell is he coming up with these ideas? Seems a bit novel. Kiran, yes, and Refinitiv, and from the exchanges, and yeah. Let's go here. Now, this is my son's junior ISA. He doesn't have Globant at the moment, but he might do in the future. Premier Oil doesn't have it all. Okay, it still has these two and leverage on them. Now, the reason I'm showing this is to say there'll be times when he's only got 4 holdings. Okay, I think at the moment he's got about 5, which is Meta, Microsoft, Apple, Amazon, Alphabet, actually more than 5, and then leverage on those, and then the S&P and the NASDAQ. The reason he has those is because I don't want to have 20 when, if you consider that he was born in 2018. Do you know, somebody on TikTok said, you look so old and your son's so young, Grandpa. How rude is that? It was so funny. I was at TikTok today and I said to him, with everything, I feel so tempted to reply back. And then I think to myself, no, keep it dignified. But I was so close to say, well, your mum wasn't around until the last 6 years ago. I didn't say that. Junior ISA, tax-free. It was at that time 4K, I think. That can't be right. Must have been more. But anyway, the point is, for those of you with kids or grandkids or whatever you're putting it into, do bear in mind that in actual fact, it's okay to have smaller pots if you're keeping an eye on the eggs. In other words, as Warren Buffett put it, put all your eggs in one basket, watch the basket. This was one of the best. I keep these emails. I should print these out. Karen, thank you. Celestica was another one I'm interested in. Yes, Celestica, you are right, my friend. Let me do Nucor first, and then we'll do Celestica, okay, as well. So this is now Nucor. right? And here we go. I'll just get Celestica ready. With Nucor, well, it's had a bit of a bounce down, and I guess you've been worried. The bigger concern with this is it hasn't quite broken through this downward trend, which I'd want it to see it do. And for me, it would really be that it's only going to happen when this stops falling and starts rising, okay, which might be a while. This could easily drop again before it makes that break, which often happens, you know, false hope. But what I would say is most people, when it falls, are going to then panic and exit. But actually, the real, if you're already holding it, the real worry point would be if it fell below there. Don't need to make that decision yet. That's the point of no return, possibly. Although by that point, you might say, well, bloody hell, if it falls there and it's done it in the past, then I definitely want to hold on. So if you're on it, you probably want to wait for it to break above there to be positive. But if it falls below there, then reevaluate at that point what happens. But for the moment, for me, it's a no action job on Nucor. The biggest worries, I guess, are on growth. But there's so much negativity around its growth that, and it seems to have been priced in, that even a little bit of positive noise should see it go up. So if I was already owning it, I'd continue holding it. But if I didn't own it, I wouldn't be buying it now because I'd be waiting for this to move up before I'd even consider it. Okay, there's that one. Thanks, Glyn. No, I apologize. Sometimes what I do is I do go into the credentials and people mistake that for arrogance. It really isn't. It's just what you've got to do when you're talking to an audience that doesn't necessarily know you is to let them know, okay, look, I know a little bit of what I'm talking about. Now, does Microsoft satisfy rating when over the last year it's been flat? Sean, it doesn't have to, because it's one of what I call my quality 5. And the quality 5 are the ones which consistently year after year have tended to produce exceptional returns, very shallow drawdowns. And so there's a presumption I will be owning those in any event, unless they form a daddy bear, which this has. And so I could have exited. But the reason, as I mentioned in my various broadcasts to my clients, I didn't, is because the other stocks in the quality 5 hadn't. And so I just I don't mind waiting onto it. It is what I call my quality 5, where the presumption is I'll be holding it. Celestica. Let me get you Celestica. Okay. So, what you see on screen is basically the way I cheat, the way I'm lazy, I guess. Does that make sense? The way I'm lazy. You might say no, Celeste. Do you know, I wish they'd give companies simpler bloody names. Oh, the age comment, Glenn, thank you. What can you do? It creeps up on you. What is a daddy bear? Nav, I will explain the daddy bear in a second. Celestica. In fact, I'll give you the whole column on it. On what is a daddy bear. Okay. So I'm going to look at the financial Celestica first, and then I'm going to give you. I'm also going to give you the chart. Well, let me give you the chart. Now, Celestica obviously been in the news because it's been sort of exponentially rising. With this one, you'd want to put a trailing stop because you don't want to give up your gains. Okay, so with something like this, where if you look at that as the trajectory, you probably want a trailing stop, which isn't going to be one which sees you risking too much. Let me just show you what I mean. If I can get there we go. If we were to say, let's say there was a long position with something as simple as that, that's probably what you want to be putting along and targeting. Let's say that movement over there, then okay, you've got your 40% there, you've got your 20% to the downside, boom, that's it. You might say, well, why do I ever want to get out? Well, just in case it keeps dropping, that's why. In terms of financials, all looks good, bit expensive. Its forecast price to earnings ratio is at 27. In other words, you're paying $27 for every future dollar of profit, whereas the 3-year average is just 17. So people have been willing to pay a lot more for this than historically. So, you know, it could be overextended because its long-term average, as you can see, is something like this. Now, were it to pull back to that long-term average price, That's why you want to have that stop. And you might even say, well, bugger that, Alpesh, I'll just put the stop a bit. There's no point putting it there because noise could knock you out. So it's a question of judgment. I mean, it's almost guesswork. You're saying, well, there's no point having it down here because it's pointless having it. No point having it too close. So where should it be? That, and am I still getting 2-to-1 over a reasonable time frame? Okay. And what is that? That's just October. Blimey heck, that's not far. Let's go all the way to next year. And if we go all the way to next year and project this forward, right, where does that take us? Well, blimey heck, way off the scale. I mean, you'd be looking at some kind of crazy returns, wouldn't you? Okay, on that, because you're looking at this, okay, going all the way up to here. That takes you to January of next year. If it were to continue, then that would be 118% return to the upside and just a 15% risk. So you might say, listen, I tell you what, I'll give it a bit more space. Okay, so that's one way to do the strategy on that one. All right, simple as that. So there were a few that you came on for, Alistair. I hope I've covered all of them that you were interested in. Okay, I don't want anybody to say, well, bloody hell, I went on that and I missed it. So this is from Goldman Sachs Wealth Management, post-retirement annual income goal, right? What you should be looking at, years to retirement, depending on how many years you've got to retirement. So if you're at retirement, this is how you divide your cash to the stocks, and tactically you can increase or decrease. Now, people say that's quite conservative. For me, that'll be zero if it's a year like 2022 and the prices are falling. Oh, Daddy Bear campaign for $1 million. It's on my blog. I'm going to find it for you. Here we go. So it's here on the blog. This is the Daddy Bear point and how we find it, and the major downturns. Okay, so I've done a whole article about it. I will put that in the chat box so that everybody can read that if they so wish. I will also on the chat give a copy of the book in case anybody hasn't. Sadly, Daddy Bear isn't in the book, but the mechanics behind it is, because I only thought of the idea more recently, and it tells you how to identify them. So it's really straightforward. So I've put that in there as well. Okay, you should all be able to see the link. And yeah, it's been, I mean, it's the best piece of writing I've ever done in my entire life. If Donald Trump gets the Nobel Prize Nobel Prize for Peace, the Nobel Peace Prize, then please can I have the Nobel Economics Prize for that article on Daddy Bear. If you don't read anything else, read that. Now, how many stocks? 20 to 40. When do you want to remove market risk? 2022. When it's a Daddy Bear, you want to be out of the market. Simple as that. Boom, job done. All right. Those are the links for more free resources, and those free resources include books and articles, the blog that you saw there, and all those other things. One of the things, like I told you before, I do as of this year, and I'll try and do more of these in a webinar, I might do a separate one, is these 40% returns that we give for our clients. We look at the hedge funds and we see which ones have got over 40% return for the last 3 years. We look at what they hold, and then we see if any of them meet our criteria. And this is old, so don't copy this one. It's from 2020. And the idea is if they've got any and they've been generating 40% per annum as a hedge fund, multi-billion-dollar hedge fund, then we want to copy them. Okay, and these are the ones we'll analyze for it. Okay, that's really it for today and the webinar. For those of you, if you are interested in the program, joining it, let me know, and I will happily send you a link to the program if you are interested. Our goal with the Great Investment Program, depending on people's risks appetite, is this. Look, the problem with what Vanguard calls moderate growth is it's going to take 14 years to double your money. 8% is what they call aggressive growth. That gives you 9 years. What we're looking at is the S&P has generated in sterling terms over the last 15 years, 15% per annum. That gives you 5 years. If we can improve that, and even if we don't, but if we do, that gets you down from 5 to 3.8 years. And you might say, well, I don't care if you don't improve it from 5 to 3.8. I'll take it in 5 years to double it. That's it. That's it. Okay. That's in dollar terms. In pound terms, because the pound thankfully always collapses. That's how quickly you can double your money. And not that that is guaranteed by any means. Of course it's not. There's another way of looking at it. Over a 2-year period, the average positive return is 32%. Okay, and positive returns happen 88.5% of the time. I will take those odds any day of the week. I will take those odds any day of the week. Okay, and that's the basis on which we work. It's the basis on which we work. Okay, thank you. What's your view on TTG? Can you review Hedge recent jump? Is it a BHS? HIMS. See if I can get into HIMS. I'll have a look at HIMS. Him and Hers Health. Is that the one? This one. Well, that looks really risky because it's exponential. So if anybody was doing this, looks really pumpy and dumpy. You'd really probably want to. I can't see somebody saying, I'll buy this and hold it for 12 months. I see this as the kind of thing where somebody would say, well, I'll just put a stop loss below last month's low. Okay, that's what they'd be doing. And they'd be looking at that upside and downside. And they'd be saying, yeah, I think I will go for last month's. Why can't I ever find it? Here we go. From that, they would probably put a stop loss there, and they'd probably, I mean, you tell me, does that look likely? But yeah, you'd want to put a 20% stop loss on that one, I'm afraid. So that's how I'd look at it. Marguerite, merci beaucoup to you too. Thank you very much. And I will see you next week. Like I said, if you want to see some of the reviews of the program and the work we do, please do. For those who've never had a SIP or ISA, you know it's really easy. You just go online, whether it's Barclays or anybody else. You just go online and you open one, and it's simple. Just beware of the big, well-known names who lose you 50% of your pension, as I say each time. Our simple approach, thanks to market momentum, market tailwinds, has generated some great returns. But that's market tailwinds. In 2022, we had to get 0% because we had to hold cash. In 2023, it was great because there was a tailwind. I didn't do it. They did. They did it. I didn't do it. And by the way, theoretically, if we pick the top 20 stocks out of all 10,000, we might have been up 1 billion%. But we weren't. Which just tells you that we're not that clever, doesn't it? Just have a simple, basic process. We're not smarter than everyone else. This is the croaky thing from Goldman Sachs Wealth Management, which I really like, which might be a bit academic to you, but it really is important because 30% is what their clients get over the long term, which is why the rich stay rich, because this is how they pick stocks. If you want to know how Goldman Sachs picks stocks, croaky is how they pick stocks. Okay, thank you very much, Glyn. A slide with your exit strategy. Is this something this is available to all, please? Yeah, did I? That should still be here then. Let me just check. The exit stuff is, yeah, I mean, whilst it's for the program, it's not particularly complicated or confidential. What I have on exits, it's not confidential because it's in my books. What I tend to do with my clients, though, is I walk them through it, and specifically for their own individual picks is to show them. So it's very much personalized, and hand-holding is what they get. So that's the exit one. Do take a photo on your phone if you wish. Okay. But they get that bespoke hand-holding on it. So I just thought I'd mention that on there. And we're starting to use AI, and it's getting cleverer because now we can upload whole Excel spreadsheets onto there and a lot more data than you could before. So we ask AI with all the data we input, if you were a Nobel Prize winning economist who's read all the literature on stock prices plus all the important academic research, weigh this data that I've uploaded and then work out which of these companies based upon that data and weightings are most likely to perform the best over the next 12 months. And we put up a ton and ton of data, which isn't unusual. It is commonplace. But yeah, that's why we do it. So anyway, for those interested in the program or reviews and looking at things, please do. I guess the most important things people want is access to the database and access to me. Those are the two main things. So if that's of interest, let me know and we shall make sure that we save you a place on there. Now, the other thing I'm going to do is just see if there's any other questions on there. Okay. If there's any other questions, let me know, or just go on there and speak to Parish as well. If you would like to book a call, he can help with that. All right, everyone, thank you all very much. I've overshot a bit, which I didn't want to do, but thank you. I hope I've answered all the questions. Oh, we've got a Q&A. Do we have any reference case studies to help you understand the exit strategy exiting before we get to the panic situation, or it all comes with experience? No, it doesn't come with experience. What happens is, yes, you have very simple rules on exit, and the exit rules will either be a fixed percentage, which will be dependent upon the volatility of the stock. So I handhold the client through that, and I say, right, for this stock, it should be this, and there's generally a default rule and a bespoke one for them, or it'll be a daddy bear if it's one of the quality 5. Simple as that. The reason for that is, if you don't have a process, you're going to panic, because the process is a plan. If you don't have a plan, you're going to panic, and that's how you avoid panic. And thank you, David. Thank you, Jeremy. Thank you, Glenn. Thank you, everybody, for saying thank you. So thanks all, and I will speak to you next week. By the way, I should say, yeah, that's where the program is. My ambition with the program is to eventually, hopefully, float this company. We want an asset management company, a bit like an Airbnb, where we don't own your assets. You hold your own assets. We give you the data and the hand holding with me. And sometimes people miss this. It's times. Okay. So I'm afraid it's not cheap. No, you're right. It'll be a no-brainer for you if you have got, say, 150 to 200 minimum in a pension or SIP, because a 10% rise, 10 to 15% rise just even once will give you a return, and then let alone into the future. Okay, so that's it, and that's why we're doing it. That's why I'm doing it. And giving the free information is part of my campaign for 1 million. Have a look at campaignfor1million.com. The campaignfor1million.com is to teach 1 million people around the world how to invest and how to add 1 million more to their portfolios. Let me know if there's any stocks I said in the email that I'd cover which I might have missed, especially Alistair. And Alistair, you can always email me if there's something that I missed. Okay, so thank you. What's my view on TDG ETF? Let me quickly pull that up. TDG ETF. Okay, let me pull that one up. There's the campaign for 1 million. TDG ETF. The VanEck. Do you mean this one? I'm assuming you mean this one. This one? Developed markets, large cap. Okay, well, let's have a look at it. Certainly on terms of momentum, seems to be picking up a little bit. If we were then to look at a long position on this, I guess if that's the projection forward, which seems fairly reasonable given, that's been its long-term growth, and we want to look at this up to this time next year, then up to this time, next year, is it giving us enough growth? Well, it's only giving us 8.48% if it gets all the way up to there. Okay, and sometimes these things look deceptive on a chart, because on a chart, if you said to me, how does that look? That looked all right, but now it doesn't, because it looks like if it goes all the way up to 39 from its current level of, where are we, 36, 8% return. No, thank you, not for me. Pretty piss poor. Okay, so no, not for me. No chance. Hope that helped on that one. Okay, everyone, I am going to therefore call it a day, and I want to thank you all, and I shall see the rest of you soon. Thank you. Oh, let me turn the screen off. There we go. I'm going to get changed now, and oh God, have some dinner. I might skip dinner. I've missed dinner. There we go.